Hello, this is Mike Swanson. I run the website wallstreetwindow.com, and the odds are you're watching this email because you got a notice about it as being a subscriber to my email list. Now, if you're not on the email list, click the link associated with this video to subscribe to it and get on it. Now, we are seeing some wild swings in the stock market, giant gap downs, giant gap ups. Huge volatility. On Monday, the S&P 500 fell over 7% after the market opened, and the stock market was halted, frozen for 15 minutes, something that did not even happen during the 2008 financial meltdown. And even though I've been trading in the markets now for over 20 years, I've never seen it happen. It did happen in 1997 at one point. But all this type of manic up and down trading has to make us wonder, is this unprecedented? Because in many ways it is, but there is one historical example way back in the past, and I'm not talking about the 1929 crash, that can provide some idea of why this is happening. And this type of behavior has actually happened in other markets outside the U.S. stock market, which can be instructive to help us get a grasp of what is going on. First of all, take a look at this chart. This is the S&P 500 right now. And going into this week, I was hopeful that we would see a double bottom, but that potential failed with yesterday's drop. And even though this morning the market is gapping up, the double bottom failure still is negated. And I frankly have not seen a convincing sign that the stock market has actually bottomed. Now, in the back of my mind, I have been thinking that the stock market may be trading like it did in 2007 or the year 2000. And that was a time in which the markets came off of a high, fell very quickly like they did the other week, and then bounced back up. And this represented the start of a new bear market. It was a massive surge in volatility, and that's typical of how bear markets or tops are made in the stock market. So look at this chart of 2007. You see what I mean there? And now we'll flip to 2000. That April, the S&P fell dramatically, over 16%. And then there was a market rally until Labor Day, and then everything rolled over. The NASDAQ, of course, was much worse than the performance in the market averages. However, Monday's drop even negates those patterns. And those were the patterns that represented the two bear market starts or stock market tops in my years of trading, and really for just about everyone else that's been trading in the markets. So this is our experience. But I've been in other markets that have begun bear markets in a different way, in particular the gold market. And the drop on Monday kind of reminds me of what happened with gold in 2013. Look at this. So gold had a major support level of 1550, and when it closed below 1550, the bear market really started, and gold traded down in a huge way for the next couple years. And if you look at gold stocks, this is the GDX ETF. It's had bear market declines that are very similar to the type of action we're seeing in the stock market now, in which gold stocks would fall dramatically 4 or 5% on any given day, and then also have sizable gap ups or rallies back up, but they wouldn't really bottom, just on those intraday moves. It would take substantial declines, but these type of bear market leg downs for gold stocks were much different from the type that are typical for the U.S. stock market that we've seen in the past 50 years, really. And that is that you would have these declines that seemed to last a very long time, but within them there were big gap downs, big gap ups, and those short-term moves is what everyone participating in the market focused on. So the big gap downs would make people think, oh my goodness, we're on the verge of a giant crash. And then the big gap ups would make people think, oh, it's all bottomed, so I'm going to buy, or I'm not going to worry anymore. And then, the hopes would be gone within the next day or a week or two later, and so forth. And this process would just seem to go on and on and on. And nothing like that has really happened in the U.S. stock market unless you go all the way back to 1937, which a friend of mine, David Skarica, he likes to talk about this bear market a lot, but it may be instructive. So take a look at a chart of the 1937 to 1938 bear market, and you can see how the market declined, going down at a steep angle. But during that decline, there were lots of big up days, which really trapped people, and the volatility was very, very high. So you can see if something like that is playing out now, that you would have elevated VIX levels, and that would actually remain that way throughout the duration of the drop. And then this is exactly how those GDX gold stock bear markets have played out in the past when it happened to them. The most recent example being from 2013 to 2016. But this also is how bear markets have also happened in other countries since the 2008 stock market top. It happened in Russia several years ago. It happened in Turkey in 2018, started there, although I think that situation probably has made a price bottom. It's happened in the commodity markets. It's happened in oil in 2014, for example, and so forth. So it's not happening in the U.S. stock market, but this type of behavior has happened elsewhere. However, there's an important point to make when it comes to drawing price comparisons to a market in the past, or something the U.S. stock market has done in the past, and to today. There can be a major flaw in this type of analysis. So, for example, a lot of times you'll see people take the 1929 stock market chart and then compare it to something going on now, or they'll use another year, like I've just used 1937, for example. The problem is these things in the stock market really do not repeat over and over again. And if you draw one single comparison on something that's happened in the past, it actually isn't statistically valid in the markets. So if you say, here's how a market bottomed and here's what's happening now, it's not statistically valid to use one example. For something to actually be statistically valid, it has to repeat at least 15 times. So this is a major flaw throughout technical analysis, the study of charts, and look, as we all have a tendency to look at the past for past comparisons, and nothing repeats exactly the same. It's Mark Twain phrase that history does not repeat, but it rhymes. And that's something to remember when it comes to the financial markets. So keeping that in mind, there are things that do repeat consistently over time that are the critical things to be aware of now. And that is stage analysis. there's a repeat to the structure of bull markets and the structure of bear markets. One is, as I have suggested, one thing that happens when a bull market comes to an end, no matter whether it just goes straight down or has a drop and then a new rally to a new high, then a drop and then a new rally, then a dump, which is sort of what happened in 2007, is that all these topping processes, or the transition from bull to bear, is characterized by a heightened volatility, which is exactly what we're seeing right now. And also, just as important, in bull markets, the 200-day moving average acts as long-term price support. That is classic stage analysis. And during a bear market, the 200-day moving average acts as resistance. The market trades below it, and when it does rally back up to it, it stalls out and goes back down. And the biggest issue with the S&P 500 right now is the very fact that it is now substantially below the 200-day moving average. You can see that on this simple price chart of the S&P 500. And this is a big problem, because even if the market were to bottom today, it's going to be quite some time before it can rally through that 200-day moving average and stay above it. It's just as likely, if it were to rally up to that 200-day moving average, to come back down, retest the low, and that's assuming it can even do that. So the risks are still to the downside as long as we remain below the 200-day moving average. And that means this remains a dangerous stock market until either you enter a stage one base, in which the 200-day moving average and the market gets close together and both go sideways, which is what has been going on with something like many individual commodities outside of oil now for the past 2 years. Of course, gold is above the 200-day moving average. So what do we do in this current market environment? And I want to have 4 suggestions. Recognize that big volatility, big swings up on a daily basis, big swings down on a daily basis is going to continue. That means big market risk is going to remain. However, the big swings make it very tempting to try to trade, and that's what a lot of people will do. In fact, one of the things that tends to happen in moments like this is a lot of people lose money, or they're down because the market has topped out, and they'll try to make back their losses by engaging in manic trading. There are people who had thought of themselves as investors while everything was going up, who are now going to start to think of themselves as traders. And they will try to buy over and over and over again. However, the very fact that the market is below the 200-day moving average means that they are going against the overall market structure and trend, and taking extremely risky bets, and actually magnifying their risks by engaging in manic trading behavior. So one thing I would suggest is, do not think you have to trade these moves unless you've already got a well-developed game plan thought out, and are not simply reacting to what's going on. And that's the second thing. It's smart to reduce the impact that this wild volatility is having on your account balance. And the only way to do that, depending on how fully invested you are, is to reduce your positions. If you're 100% invested in the stock market, the swings are impacting your account on a one-to-one basis. And if you're on margin, they can be extremely financially devastating. So the only way to reduce the risks is to raise cash reserves and, frankly, even move some money into gold. Because I think ultimately gold is what is going to benefit from what is only now beginning. And gold is still up year to date. Gold is still above its 200-day moving average, in fact. So the third point is I think it's too early to try to guess the bottom. And I know every time there's an up day, at this point, everyone's going to want to call the bottom. And I was trying to find a bottom myself. But once we fell on Monday and pushed the market this far below the 200-day moving average, for me, the situation has changed. And I think it's going to take more time and more work before we see a true end to what is happening in the markets now. So it's going to be extremely tempting to try to guess the bottom. And I'm just saying, hold off on that. That kind of goes with my first point, perhaps the most important point. Don't feel like you have to trade the market now. This is the time that most people should be cautious. Most people will actually need to reduce their risk in the market. And as far as buying goes, my fourth point, final point for this video, is if you want to buy, actually the best things to do are not at this point to buy the S&P 500 or the Dow or the popular technology stocks, the Facebooks, or the stocks like Tesla, or the stocks like ACB, which is still remaining the top 100 most number one owned stock among Robinhood traders. No, the things to actually be looking to buy or to try to buy are things that are actually outperforming the market averages, that are either bucking the trend or look like they're poised to do so. And that may mean it's time to reevaluate your holdings. So personally, myself, I have done that and sold some things over the past few weeks. For example, in January, I bought some energy stocks, thinking that they had a chance to rally above their 200-day moving average and they pay good dividends. And that rally failed. And not only did it fail, but those stocks started to break down 2 weeks ago before they collapsed basically on this past Monday. So I was getting stopped out before the Monday drop. But they're not something that I'm looking to buy at this moment. I'm still interested in getting into them at one day, but they're not bucking what's going on in the market. Gold is, but there's some other stuff that outside gold that is starting to look attractive. I'm going to do a private update about that to the Power Investor members, most likely tomorrow morning. So these are thoughts I've got about the market today. I guess the two big takeaways I want you to really have from all this is, number one, we are seeing a significant breakdown in the stock market. And I think we all have to recognize that. The market has fallen far away from the 200-day moving averages. The double bottom potential pattern failed. And this means the stock market risks have increased. Even if the market were to go up today or go up for a week, that reality has not changed. And that's something we must take seriously. Takeaway number two, reduce risks. And hedging is another way to do that. That's something I'll be talking about with the Power Investor members also. It's a lot of stuff going on in these markets. And if you're not on my email list, you need to get on it to get my future updates. So click the link associated with this video to do that now. And I'll be talking with you later.